Hello, my name is Lisa Berger, and this installment of the Optimum Academy is going to address juvenile insurance. So the purpose of insurance on children, normally it's to cover burial expenses, to protect their future insurability, or to provide savings. So those are really the reasons why we would insure children. Some people ask that question. They don't usually have income or assets, but these are needs, and insurance provides for those needs. So here are some basic rules around coverage on children. So the criteria is that the product should be permanent, not term. The amount of the insurance needs to align and make sense with the family finances and coverage amounts for the family members. And in some states, the amount has to conform to state limitations, such as in New York or Washington. So for the state of New York, their criteria is that for minors up to the age of 4.5, the maximum amount of life insurance, including in force and applied for, so the total amount, that could be issued on that life is the greater of $50,000 or 25% of the amount of life insurance in force on the life of the policy owner. Normally that's a parent or maybe a grandparent. For minors over the age of 4.5, the maximum amount of life insurance in force and applied for that can be issued is a greater $50,000 or 50% of the amount of life insurance in force on the life of the policy owner. Now, Washington also has special rules as well, and the amount of other life insurance contracts on the life of the juvenile that are in force or applied for at the time of application must be obtained. So they're looking at what's the total risk for that child. The death benefit must be grossly proportional to the value of life insurance issued for other siblings or immediate family members, and if not, justification needs to be provided as to why that equivalency is not being required. The overall amount of the insurance on that juvenile should not exceed the annual household income, but if it does, a justification as to why such an amount would make sense. Now, when insuring children, we want to make very sure that there are no concerns of possible fraud or a situation where the child's death would result in a windfall to the beneficiary. So some warning signs to look out for. We call them red flags and yellow flags. Red flags are usually a hard stop, or yellow flags are something where you might want to get some more details in with those details that might make sense. So the red flags are, if not all of the siblings are being insured for amounts that are the same, if there's any disproportionate face amount or plan premiums, we're talking about permanent life insurance, so the premiums based on their ages can vary what the face amount. So either the parent would want to see $50,000 on all the children, or what $10,000 a year would buy for each of those children at their various ages. So that needs to be proportionate. So if it's not, that's a red flag. If there is an amount of coverage on the children that exceeds the coverage that's on the parents, that's a huge red flag. As well as there being no regular well child visits and no doctor to obtain an APS on. When you're looking at the health of the child, we're not getting exams, we're not getting labs on these kids, so we rely on an APS. So we want to make sure that these children are healthy and well cared for. Now, some yellow flags, these are cautionaries if maybe only one parent is being insured. It might be a single parent. It could be that the other parent is uninsurable. There's other reasons, but we need to ask those questions. Also, if you have a non-custodial parent obtaining coverage, they may not be aware of all of the medical situations for that child or the enforced coverage. So asking for more information in these situations makes a lot of sense. So let's compare two options for how a file may come in on a 6-year-old. So if we have option one, this child's coming in for $100,000 on both of these. Option one is there's a single parent, there's no earned income listed for that parent, and no enforced coverage listed for the parent or for the siblings. Now, another option that you might see is the same single parent, but they provide an income of $100,000. That parent has $1 million in force on herself, and all of the siblings are all applying for $100,000 each. And in this particular situation, we're obtaining the applications in the state of Washington. So when you consider the following, which of these makes more sense? One, when we look at family income and we look at no income versus a nice income. If we look at insurance in force on the parents and the siblings, there's none versus proportionate amounts. And then looking at following all the state criteria. So in considering these two, there's obvious concerns in option one. Why would a parent with no income insure only one child, not herself, which, that parent should be insured so that the children are cared for. But only insuring one child out of a group of children just really doesn't make sense. That's a pretty adverse situation. Now in option two, the amounts are even among the siblings. It's proportional to the parent. The income makes sense, and the state criteria is taken care of. So in this, option two is what you want. Option one is not going to be acceptable for most situations. Now there may be unique situations when insuring kids. So coverage might go beyond the normal burial expenses, future insurability, or savings. And we can consider coverage for college students that are close to graduation. They're not juveniles, but they're not quite yet adults. There's also juveniles that may have income or assets on their own. You could have various situations. And there's also generational trusts. Now we're going to talk about college students first. They're in between being an adult and being a child. They're not minors, but they're in limbo before starting their career, so they may be at the cusp of being self-sufficient. You can normally consider a college student for a higher face amount than you would an actual juvenile that's under the age of majority if graduation is imminent. They might have a job offer letter with a salary and a start date. And you can also use a reasonable anticipated salary for their chosen career. Now, you still need to want to look at the same flags on these, looking at the coverage amount on the parents and any siblings, as well as the parent income. The whole picture really needs to make sense financially. Now, here's a case example, a 23-year-old college student that's coming in for $500,000. Now, we know that he's graduating in 6 months, and he's going to have a degree in accounting. He doesn't have any job offers yet, so we don't have the job offer letter showing a start date and salary. But he has interned at 2 local accounting firms during tax season, and he's currently interviewing. Now, the income for the parents is combined at $200,000, and each of the parents has $1 million in coverage. So the question is, can we justify this amount? So, while he doesn't have a job yet, he really is close to graduation. He does have experience, and we know his chosen field. Now, in this situation, we can do an online search for average starting salary for accountants, and you can do it by age, or you can do a national average, and it shows about $57,000. So if we're looking at 10 times income for him, that's really not a big a stretch, as well as looking at what's proportionate with what the parents have in their income. So in this one, we don't know about siblings. We may want to ask to make sure that they have coverage in force. And there's other questions that you can ask. Is he living on his own yet, or is he dependent on them? Is he still at home? You might be able to justify more if he's living on his own. But with what we have here, if we know that there are no siblings, or we find out the siblings are doing something proportionate, this normally would be acceptable. Now, some children have their own assets or their own sources of incomes. So if they have, royalties, dividends, or assets have been gifted to them, the need can be there for insurance beyond the usual burial or future insurability amount. So the assets being set aside in a trust with a child as a named beneficiary, and those trusts being irrevocable, ensures that they've been transferred out of the parent's estate and actually to the child. If they're not set aside for the child doesn't actually have ownership, and without ownership, you probably aren't going to be able to justify coverage. So looking at the type of trust that's set up is really going to be key, and this is something where you want an irrevocable trust. Now, there are juveniles with assets, and as long as the assets are actually owned by that child, like I said, with an acceptable trust, we're going to need to know more. We're going to need to know still know the parent's income, their net worth, their in-force amount, the overall estate plan, making sure that there's coverage on all siblings for similar amounts, and the trust type is acceptable. And as I said, irrevocable trusts usually are. So we're going to go over what those trusts are that we're going to want to see. So what's acceptable? Irrevocable living trust. They transfer those assets out of the grantor's estate, reducing the estate taxes for the grantor, and they place the ownership of the trust in the named beneficiary. And the situation would be, a juvenile. There's also grantor retained annuity trust or grantor retained uni trusts. It's hard to say. So these transfers the assets to an irrevocable trust. Again, irrevocable being the nature that's acceptable. And it retains an income stream for a specified period, passing the assets to the bennies at the end of the term. So both of these types of trusts will list the beneficiaries, and having a copy of the trust will spell out what the details are very nicely, and understanding that the child that's being insured needs to be listed as a beneficiary of the trust for it to make sense. A lot of times it will name all children if there's more than one child, and you want to make sure they're getting applications on all the children. But that will spell this out nicely. So a couple more acceptable trusts are generation skipping trust, where the assets are transferred to grandchildren and it skips a generation. And we take advantage of the tax exemption for gifting. Now, dynasty trusts transfer wealth from multiple generations, again, protecting assets and minimizing estate taxes, which is really the key for those. And in these are irrevocable, and they are acceptable for life insurance, especially with wealth transfer. Now, there's a few unacceptable arrangements when you're considering a very large amount on a child, when you're looking at a estate preservation, a wealth transfer situation. So if the trust is a revocable living trust, these don't guarantee that the assets are going to be transferred. It allows the grantor to maintain control over those assets during their lifetime. And the assets could be diminished or completely used up before being passed to the child. So there's no guarantee with a revocable living trust that the child will ever obtain those. You may hear that, inheritance is coming, they're going to inherit this. And that's, a verbal agreement, but it's not enforceable. What you really want is a trust that is enforceable, and those assets are going to be delivered to that child. Other things that are not acceptable is when there's no trust established. It's like I said, it's just verbal. So the bottom line in looking at this is whoever is being insured needs to be the owner of those assets. And looking at the type of trust and the arrangement is going to tell you that information. So here's another case example on a 12-year-old girl. They're coming in for $2 million of whole life. The cover letter notes an irrevocable trust will be the owner, so that's good, Benny and the payer. The parents are setting up the same trust for their 3 children, and all applications are submitted together. The household income is $10 million, and the net worth of the parents is $90 million. Each parent has $100 million in force. The purpose of the insurance is to fund each of the children's trusts at $5 million each, which is going to remove $15 million from their estate, 3 children times $5 million. And establishes coverage for the kids. So they send in a copy of the trust, and it shows all children are the beneficiaries of the trust. So do we have any concerns here? We've really checked off the concern of this being irrevocable. The income of the parents and the net worth is significant. Each parent has a very large amount of insurance in force. Applications are coming in on all the kids for a similar funding amount. So this is really a good example of what may be acceptable. So, when we see large amounts on children, we don't see them often, but we do need to, ask these questions. Why do they need the amount? What's driving it? Is it assets? Is it premium amount? And if the trust isn't set up or the child doesn't have ownership, those amounts may not be justified. As I said before, the parents can use up all the assets and nothing would be left to transfer. But in this particular situation, with an irrevocable trust, that has been taken care of, and this would be acceptable. Now, some final thoughts on juvenile insurance. The amount of coverage has to align with the amount on the other siblings, the amount with the parents, and the overall income for the household. If your state has specific guidelines, obviously we need to follow those. And larger amounts in unique situations You may not want to say no first. They may be acceptable, but you're going to need supporting information to get there. And if the assets are being covered, the insured needs to be the owner of those assets. And finally, does it make sense? Obviously, with underwriting, that's a great question to ask along the way, regardless of what situation you're in. So I want to thank you for spending some time with me. And if you have any topics you'd like to address or have any questions, just let us know. Thank you.